Hey Maddie, so here is a real simple, quick introduction to chart analysis using technical analysis. So here's Amazon, and you can see the cursor moving, and each day I move it, it shows the open, the close price. See that vertical line? Now, at the chart here, it's called the stochastic. You can see, you won't be able to see anyways, down here, the red and the pink line. So you see how it goes up, and then it goes down, and back up, and back down. So these are, it doesn't matter, what this is representing. You're just looking for the pattern. And I'm starting with one technical indicator, the stochastic, because I find it quite reliable. And when you hear reliable in terms of investing, it just means it works more often than it doesn't. Nothing can ever work all the time. Nothing can ever work even 80% of the time. Otherwise, it doesn't work. The reason is people start to use the same indicators, and then they go against, they short, they go long. It just, there's no really opportunity for arbitrage just using one indicator. So you have to have your edge, and without getting too much into that, because that's a topic for another day, I just want to show you the stochastic indicator. So the way you add that, this is on my Android app. It's slightly different for iOS, but not too different. You just click on it, it brings up this menu, and then I click over here. Over here is the little hourglass. Looks like a little, I don't know, teepee. So you click on the teepee, and I have two stochastics there. You really only need one, so I'm going to remove that and mark. There you go. So when you expand it out, you can see that when it's really overbought and oversold. So overbought is when it's peaking. Up here, and going back up here. So when that happens, when the red and the orange line are above the 80, then it usually is followed by a reversal, because the numbers can't keep going higher. There's just a multitude of reasons. People take profits, meaning they cash out, they see the price going up and up. So then more and more sellers start putting, their orders out for, limit orders. And as they get taken, it drives the price down and down and down. Eventually it starts to really go down when they see the price going down. And then people want to get out. It's a multitude of reasons. But to bring it back to most simplistic, when it's up here in the stochastic, you can see this, above the 80 line, that's when you either want to sell it or go short, because it's usually followed by what's called a mean reversion. Everything tends to revert back to the mean, meaning it's all kind of elastic. When it gets overbought, it reverts back, but highly likely to be followed by a snapback, whether it gets, oversold 2 times the standard deviation, or overbought. Again, I'm starting to sound like a shitty professor, just trying to wow you with technical terms. It really does require like a conscious effort to not get carried away. But back to the simple instruction, it's looking for these patterns. And the way you can back test it is you go back in time. So what did Amazon do when the stochastic fell down below the 20 line? And you can get a specific indication if you click and hold, you drag the crosshairs it'll give you the exact reading. You know, it went down about under 20, and that was followed by a move upward. You can see it, you know, up here. It starts to go up, and then see how it's up here. It's way overbought. So you know it's most likely going to tick down a bit. But Amazon was so bullish that even when it ticked down, it ticked back up again. But of course, here's what I was predicting. And of course, it's easy to predict the past. But you see how it starts to fall down here? It goes, you know, from a high of, you know, around 1750 down to a low of about $100. Below that, about $16.50. It falls about that much. So if you were to sell here or go short here, that would be equivalent of a $100 profit per share. Similarly, you wait, and eventually it'll always go back down here. Wait till it goes down here. And, you know, again, even though when it goes down here and it's oversold, it still is higher than it was back when it got oversold last time. You know, see over here. But that's fine. You can jump in and out of the stock. That's how people day trade or swing trade. Just quick movements. You're riding the stochastic. And it's not a technical term, but that's, you know, a description of what you're doing. You're just playing the movements in the stochastic. And a good strategy is to liquidate everything on Friday. That's something you could experiment with. That way you're not blindly holding positions. Now, there are advantages to doing that. You avoid some capital gains, but at this point, just get used to clearing out your ledger, you know, every Friday. And Friday, more often than not, is bearish. Monday is slightly less bearish. Tuesday, Wednesday, Thursday are usually when there's the most volume. See a lot of the bullish runs usually during those 3 days. So that's it. I want to try to keep it short, and I already went over 5 minutes, but yeah, let me know how I can make this better and more helpful. Bye.